The S&P 500 isn't actually a passive investment, and most investors have no idea. This analysis was requested by our subscriber, Just Alexander, 1992. And I'm glad they asked because this is something every S&P 500 investor should know. This is a full breakdown of the world's most popular index, the S&P 500. There are things you probably already know, but I guarantee at least one of these points is going to surprise you. If you own an S&P 500 index like VOO, can you afford not to know this? If you find this analysis valuable, hit the like and subscribe button. I create content based on what you ask for, so engagement helps me know what's useful. We're going to start with the scary question. Is the price of the S&P 500 too high? Multiple valuation metrics and data points indicate the S&P 500 is significantly above historical averages. Translation, it looks overvalued. Many people forget that it's not just what you buy, but what you pay for what you buy that counts. Study the data first. At the end of the video, we'll talk about some practical options for investors. For now, just listen. Let's start with the Shiller P/E ratio and the Buffett ratio. If you want to examine these charts yourself, use the form in the description. You can see that both charts indicate the S&P 500 is approximately double its historical average. In simple terms, this means that unless corporate profits experience a dramatic increase, stock prices would have to decline by 50% just to return to the average. Mean reversion is a powerful concept. It's the idea that over long periods of time, prices and valuations tend to gravitate to long-term averages. When prices are far above the average, they're more likely to decline, and when far below, they're more likely to rise. It's a powerful concept which tends to hold true over long periods. Investors need to get comfortable with the idea that it's not controversial to say prices are high. In every domain, prices can be too high, too low, or fair. When you go to the grocery store, you can tell when chicken is on sale and when it's not. Stocks are the same. Right now, stock prices are at historic high levels. Okay, so what could trigger a decline in stock prices? There are any number of factors. A simple one, corporate profits simply not meeting expectations, particularly in the tech sector. If expectations aren't met, prices decline as investors realize they paid too much. Here's a recent example. Oracle reported financial results and the stock declined 11%. Keep in mind that Oracle's sales increased 14% from the previous year. Imagine you own a business that sold 14% more and is now worth 11% less. This is what happens when expectations are too high. There can also be any number of unexpected events. Just think about COVID. Another problem increasing stock market fragility, stock market debt is at record highs. Margin debt is debt investors borrow to buy stocks. Prices decline, brokers can demand repayment, which requires investors to raise cash. One typical way this is done is by selling their stocks. Those additional sales cause further price decline in a feedback loop. High levels of margin debt create fragile stock market conditions. When an unexpected event occurs or expected high results don't materialize, prices can decline more sharply than they otherwise would. Investors are less able to hold on to their positions, and so unexpected volatility can cascade through the market. In addition, high levels of margin debt itself can begin a selling cycle. Why? Well, because the investors get nervous. They know they are heavily borrowed, they know prices are high, and they decide to take some risk off the table. They sell, which causes prices to come down a bit, which makes other heavily borrowed investors get nervous. They sell, and so on. For context, a Canadian finance professor, George Athanasakos, noted that current levels of margin debt are higher than at any other time in the history of financial markets. Typically, investors do not want to be breaking records in terms of the amount of debt they carry. When it comes to market indicators like these, I suggest investors think about them like a thermometer. A thermometer can tell you that it is hot, not that it's about to be cold. It doesn't give you a perfect forecast. The good news is, as an investor, you don't need a perfect forecast. In fact, you should already know that that's impossible. Rather, consider investing like a blackjack player would. You play the odds. Changes in valuations change the odds. When prices are low, your chances of making money are better. When prices are high, it's the opposite. Your goal is to make money in time, not on time. This is the current environment for the S&P 500. Prices are high, perhaps twice historical averages, expectations are high, debt levels are high, technology sector concentration is high, earnings expectations are high. If you're investing in the S&P 500 right now or are considering it, don't look away from this data. Study it. Then develop your plan and strategy to deal with current market conditions. If you stick around the end, I'll walk through some practical options and strategies investors can use for themselves. With S&P 500 valuations elevated, investors naturally start to wonder what type of performance they might expect going forward. Let's look at some historical performance numbers for the S&P 500 and a few ideas for expected returns. First, the historical performance. The data in this chart comes from shillerdata.com. It is the website for Professor Robert Shiller, the author of the Shiller P/E ratio. From 1871 to 2025, stocks have returned approximately 9% annually after you include dividends. Dividends make up a large portion of historical returns at around 4.2%, almost half according to this data set. One thing to note is that with a simple analysis like this, it doesn't include compounding of reinvested dividends, so actual returns would probably be higher. Dividends for the S&P 500 today are far below historical levels, roughly 1%. This reflects both elevated stock prices and a modern preference for share buybacks over dividends. Performance data shows that VOO has returned approximately 14.5% over the last 10 years. A simplistic way to think about expected returns is that to merely hit the 9% annual average over a 20-year period, the last 10 plus the next 10, the S&P 500 would need to return about 3.5% annually for the next decade. Incidentally, this is not too far off the data put out by JP Morgan near the start of 2025 that compares forward PE ratios with subsequent 10-year returns. In every case, when forward PE ratios of 23 times or higher, like they are now, returns for the following 10 years range from approximately minus 2% to 2%, or essentially zero. Again, we're playing the odds. From this data, what investors should be able to reasonably say is that having annual return expectations of 10% or more for the next decade is probably too optimistic. The starting point is just too high. In addition to elevated starting valuations and above average recent returns, certain tailwinds that have historically pushed stock prices higher are no longer available. Since the 1980s peak, interest rates have more or less gone in one direction, down. This has pushed up price-to-earnings ratios. Lower interest rates makes companies more profitable by lowering financing costs. It makes stocks more attractive relative to bonds so investors can pay higher multiples. It makes margin debt cheaper, enabling investors to take on more leverage. It changes discount rates for cash flows, thereby increasing stock valuation estimates. Long story short, lower interest rates equals higher stock prices. The problem is that interest rates have already declined from the peak. This acted as a boost to get stock price to where they are today, but it's not going to be available to juice returns going forward. This is another factor pointing towards lower S&P 500 future returns. You're starting at a high valuations, previous 10-year returns are way above average, dividend yields are very low, and interest rates have already had a multi-decade decline. Remember, the game is buy low, sell high. When lots of things are making new record highs, it pays to be cautious. We've already discussed how valuation ratios are at record highs and that margin debt is at all-time highs. Here are some other records that being broken that suggest the current environment carries elevated risk. Gold and stocks soaring at the same time. According to the Financial Post, the Bank for International Settlements has warned that a situation where both gold and stocks are soaring at the same time has not happened in 50 years and is a cause for concern. Gold is supposed to be a safe haven asset. It's not supposed to boom when risky assets like stocks do. Measuring the, quote, explosiveness in price action, the bank noted that the past few quarters represent the only time in at least the last 50 years which gold and equities have entered this territory simultaneously. It also noted that most of this is being driven by retail investors. Corporate profit margins at record highs. This matters because it indicates how much corporations are being allocated a share of national income. Increases in corporate profit margins cannot continue forever. Eventually, that becomes socially and economically untenable. An article from April 2025 by the St. Louis Federal Reserve Bank concluded the following. Corporate profits have been elevated since the onset of the COVID-19 pandemic. As of the last quarter of 2024, they were $4 trillion, 2.3 percentage points higher as a fraction of national income than they were prior to the pandemic. This increase was entirely driven by domestic non-financial industries, notably retail and wholesale trade, construction, manufacturing, and healthcare experienced a marked increase in profitability. Higher corporate profits mostly went to rewarding shareholders via dividends. 2.3% on $4 trillion is a lot of additional income. And again, that's come from mostly from the real economy, and most of those extra profits went to shareholders through dividends. As you can see from this chart, corporate profits, both in aggregate terms and as a share of U.S. national income, are at record highs. You might be wondering, yes, but isn't that good for investors? Almost. It has been good for investors. The question is whether or not it will continue to be good for investors going forward. Don't forget, should corporate profits and profit margins revert to lower levels, that immediately impacts stock valuations as the E in PE goes down. Market concentration at record levels. The top 10 stocks in the S&P 500 now represent more than 40% of the index value by weight. Most of those stocks are technology related and bolstered by AI hype. A recent YouTube video by Ben Felix, who does fantastic work by the way, notes that 75% of the S&P 500 returns and 80% of corporate earnings growth has come from AI stocks since the launch of ChatGPT in 2022. Ben considers market concentration in the context of valuation and returns. I'm not challenging his conclusions, but it seems hard to argue that investors aren't exposed to a riskier position due to reduced diversification. It feels like a double-edged sword. If you own a larger proportion of the stuff that's going up, you are more concentrated, but your returns will be better. It also does not mean that just because you are concentrated, future returns will be worse. Warren Buffett basically owns one stock and he's doing just fine. What it does mean is that should the performance of the stocks within the highly concentrated position deteriorate, you are exposed to a greater share of the downside. You've probably heard the quote from Warren Buffett at some point that goes, "Be greedy when others are fearful and fearful when others are greedy." This is what he's talking about. Everything is up. Everyone is excited. Yet Warren Buffett is sitting on almost $400 billion in cash, and his company is only worth $1 trillion. That's like having 40% of your portfolio today in cash. The greatest investor of all time. Think about that. 40% in cash today. Okay, that was the uncomfortable part. Don't leave yet. We're going to talk through some practical strategy for investors in a moment. In terms of the S&P 500 itself, it's difficult to bring new analysis to such a well-known and widely owned index. The index was launched in March 4th, 1957. The first value day was back-tested January 3rd, 1928, just before the Great Depression. The index contains 503 stocks from 500 individual companies, as some companies have multiple share classes. The S&P 500 includes only large-cap companies, but represents approximately 80% of the total U.S. market capitalization. This does mean that investors are missing exposure to mid and small cap companies. Investors can, of course, get that exposure through different indices if they wish. The index refreshes its constituents regularly. Change is one of the greatest strengths of the index. What you own as an investor is being refreshed without you having to do anything in your portfolio. Technologies, products, mergers and acquisitions, business fortunes, all change over time. An index that changes with it is a good thing. And while it's true that 10% of companies represent 40% of the index by weight, that also means 60% of your money is distributed among the remaining 490 companies. So there's a high component of concentration followed by a wide diversification. Here's what might surprise most people. The components of the S&P 500 index are selected by a committee at Standard & Poor's. The S&P and US Indices Methodology Manual states, constituent selection is at the discretion of the index committee and is based on the eligibility criteria. The indices have a fixed constituent company count of 500, 400, and 600 respectively. Sector balance, as measured by a comparison of each company's GICS sector's weighting in an index with its weight in the S&P Total Market Index in the relevant market capitalization range, is also considered in the selection of companies for the indices. Translation. Subject to sector and market cap considerations, the companies that make up the S&P 500 are selected by a committee of real people based on a selection criteria they maintain. So if you thought the S&P 500 was somehow automatic or algorithmic, where companies are mechanically included or excluded based purely on size, that's not quite right. Real people make these decisions. The credit, of course, is that they've been so successful over a long period of time. This table is a sample of various S&P 500 mutual funds and ETFs. Some are in US dollars, some are Canadian or Canadian hedged. There are tons of funds connected to the S&P 500. The fact sheet from Standard & Poor's website has 7 pages of quote related products, and they also disclaim that the list may not be complete. There's lots of options. The key thing to note is that they are more or less generate the same returns over time. To that end, investors should probably prioritize those funds with the lowest expense ratios. It's not a huge difference. On every $100,000 invested, a 0.05% lower expense ratio amounts to $50 saved per year. That said, if all S&P 500 funds are essentially providing the exact same results, which they should if they're doing their job right in tracking the index, you might as well save on cost, assuming there are no constraints preventing you from doing so. One additional advantage of ETFs like VOO over traditional mutual funds is tax efficiency. ETFs have a structural advantage that allows them to avoid distributing most capital gains to shareholders, which can result in meaningfully lower tax drag over time for taxable accounts. The S&P 500 has been one of the best performing long-term investment decisions investors could make. There is no reason not to expect that necessarily to continue over the long term. In the near term, risks related to valuation and expected returns shouldn't be ignored because they're uncomfortable. Investors have options. Option 1, build up cash reserves. If you feel like you have too much equity exposure, don't want to sell, but don't want to add more stock to current prices, one option is just to start building up cash. You could cut dividend reinvestments or direct new deposits to money market or investment interest-bearing accounts. This provides a dual benefit. Some shock absorption should prices revert to the mean, and financial capacity to take advantage of investment opportunities when they arise. Option 2, calculate your total net worth and understand its components. Then consider your specific situation. For example, if you are young and able to save and invest for decades, Perhaps your current S&P 500 exposure isn't really a problem, even if it's high compared to your total net worth. Conversely, if you're close to retirement with high equity exposure, it might be worth considering diversification into more fixed income investments despite lower returns. Remember, if mean reversion holds and history is any guide, current valuation levels suggest potentially much lower returns ahead anyways. Option 3. Consider the absolute percentage of your overall net worth that the S&P 500 represents. If your S&P 500 allocation is only 5%, then even if prices drop 50%, you haven't had a catastrophic change in your net worth. It's always important to keep in proportion the risk you're actually holding. You might have 5% in the S&P, but also a house, a good job, a pension, other fixed income savings. If you're well diversified with opportunities to build wealth over time. Don't shy away from examining your current risk profile of the index, but don't lose sight of your overall picture, your age, your income, and your other assets. Option 4, shorting. This is one I personally don't recommend for most retail investors because it's very specific and you need to know what you're doing. But there are things like S&P 500 put options. In general, you can short stocks overall or certain specific stocks that you think are overvalued. I don't really think that that's a great option for most investors, but it is available. And so if you're experienced with short selling, that's one way also to protect your portfolio or certain sections of your portfolio that you think are specifically overvalued and you're worried about. The S&P 500 is one of the most important financial products in the market today. Investors are right to consider it. At the moment, the situation appears to be that the index is demonstrating record highs, which collectively point to elevated risk for investors. Investors looking to continue to own the S&P 500 would be wise to look for ways within their portfolio to moderate, mitigate, or balance out these risks so they're not unduly affected should conditions deteriorate. That's it. If you have a fund or financial product you'd like me to analyze, leave it in the comments below. Hi, I'm Charles. I don't like most investing and finance content online. It tends to try to sell you something. You don't need to buy anything from me. This content is for entertainment purposes only. Seek professional advice for your situation. I want to make financial freedom accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.